And sorry about missing yesterday again, right? My boy, my son, my life right now. He just like came out of the blue. It's like there was no warning or anything. Literally, like we had to like rush to the hospital, and it was like, you know, it just took us by surprise. But yesterday we'll be talking about a couple of theories, if you will, or concepts which I have, well, I'm the only one that's you're gonna ever hear talk about this. And this is new, no one ever talked about this before. It's a different way of seeing, you know, order flow or liquidity. So yes, let's, try to refresh everyone's mind, right? Remember we said that Monday and Tuesday, would be low probability. You would expect movement on Wednesday, which we did have a crazy amount of movement, on CPI. And before we look at the charts, I want you to understand, I want you to know that, the high and the low of the day, whichever day, whether it's Tuesday or Wednesday, but it will always be the second week of the month, right? Whichever day we have CPI, right? If we are close to the low, that low will have a enormous amount of liquidity below it. And if we're close to the high of the previous day, if it was CPI, then that high will have a lot of liquidity above it, right? So these highs and lows, and I'm talking about CPI because like after CPI, the day which follows CPI, it's usually the day that like sets, the trend for the week. The actual trend is like, so CPI is usually like manipulation, but they inject a lot of liquidity, get people, induced, get people, minds turned towards the direction in which they push the market in. For example, right? They dropped the index futures market on CPI yesterday. And today, what we expected to happen, right? The low of the weekly cycle so far, right? It was formed on Thursday, but on Wednesday for one of the other triads, which was the NASDAQ, if I remember correctly, right? So literally, right, to me, in my opinion, when it comes to finding, one shot, one kills, like that trade that, will be in, your favor most of the times, high probability. You don't need a high time frame PDRA. You could use one if you want, but you don't need one, right? You really just need premium, discount, sequential SMT, and what else? And the gap. Also, today we will be looking at, another type of cracking correlation, right? That is different from the SMT fill, right? Which, the assets which usually, cause this, would be like, for example, the index futures. For index futures triad, it would be the Dow. For the forex market, it would be GU. For the bond market, or the interest rate triads, right? The markets that control everything. It will be the 5-year T note, right? So now we will look at the interest rate triad, right? So here, right, we're using the 1 hour time frame, right? Right now, at the moment, we're focusing on the weekly cycle, right? And it's just because personally, I love the weekly cycle, just because like just focusing on the weekly cycle, you can find a lot of trades. If you are trading in the direction of the order flow of the weekly cycle. So for example, here, this high, right? These highs, you can see that price, right? Traded above the high of this cycle. Well, this cycle's quarter right here, which would be Tuesday, right? So it's Wednesday, traded above Tuesday. Then here we had Wednesday, trade above Tuesday's high again. Also here we had Wednesday, trade above Tuesday's high again. So here, if you're just looking at the interest rate triads, what would you see? You'd see a symmetrical market, right? And as you guys realize, I'm not using any lipstick right now, right? Because like at the end of the day, I want you to be seeing this, this type of price action easily, just waking up in the morning, just opening up your phone and just looking, or just, grabbing your iPad in the morning, right off of your desk, which is what I usually do. Just look at it. Or, if you're someone like me, you have a bed in the room that you trade. So you sleep there. And, always keep your screens on. So I'll just wake up in the morning and I'll just literally just glimpse at the three triads to see if something is there to work with. Literally, right? And it depends on which type of trader you are, right? If you're a scalper, then you would, you'd be functioning within the 90-minute cycles. If you are a day trader, then you're more than likely going to be using the daily cycles, right? You're going to want to be, catching or trying to catch the high of, the sessions. Like, for example, you try to be in at the high of London, exit at, the low of New York, or, something of that measure. If you are someone that, you have a bit of patience, or you don't even have to, have patience, or you would just like be a person, for example, that, you can't be looking at the charts at the time, all the time, right? So you would be, more, or you'd find more success in trading the weekly cycle. Why? Because you would just be, trusting the concepts that, we talk about and no one else talks about, right? You'll be trusting these concepts and you'll just be applying them to the weekly cycle. Right. So, and when you're looking at the weekly cycle, as you can see, because we're looking at the weekly cycle right now, remember it's fractal. So anything that happens here happens in the daily cycle, happens in the 90-minute cycle, happens in the micro session cycle, happen, the yearly cycle, everything, the quadrennial cycle, all of them. Right. So right here, we're just focusing on the weekly cycle because currently that's what, personally, I want you guys to be focusing on, because I think that if you understand the weekly cycle, it'll be easy for you to find day trades. And if you understand, the weekly cycle, then, it's easy for you to find one shot, one kills, as the weekly cycle is the basis for all of that. So here, right, as you guys can see, right, higher high, higher high, higher high. Now look at this higher high. This higher high was formed on Wednesday, right? This is the interest rate triads. They all form a higher high on Wednesday, but they're reversed. There was no cracking correlation here between them, but there was a cracking correlation between these and the Forex market. So due to the fact that we made a higher high here, what would, what should have been, what would have caused symmetrical price action here, which would probably not, cause price to reverse, right? If this made a lower low, and here made a lower low, and all of these three made a lower low, then we would expect price to just continue lower. But here you can see the price made a higher high here. No, a higher low here, my bad, right? Failed to take out Tuesday's low. Whereas within the interest rate triads, we took out Tuesday's high. See, right here, failed to take out Tuesday's low. Right here, failed to take out the high of Tuesday, right? Right, and these two asset classes, GU and GBP, they should be moving in the same direction, doing the same thing that, this is doing on a regular day. But here, this made a higher high. These, GU, GU and EU, they made a lower high. So this was, intermarket sequential SMT, and that's why we had price, fall lower. And even after this, right, if you're someone that's, GT, right, right here, you can see that, this candle right here, before it broke down, and I will use the crosshairs for this, right? Before it broke down, you can see that we, made a higher high here as well, right? It's if you look at the lower time frame, for example, the 5-minute time frame, you would see this, right? And remember, if you're using the 1 hour time frame, for example, then you would use a, for a higher time frame, reference point, then you would be using the 5-minute time frame for entry. And I'm just saying that it's not necessary right now because you don't really need to be going into, really lower time frames. Just based on the fact that these made a higher high here, you could literally just, enter within this fair value gap and just put your stop here. And even if you entered here and you put your stop here, or you entered on the rejection block and put your stop here, then you would still be quite safe. So yes, so this is, the reason why the markets turned around. And then below at these lows, you can see that we have what you would call, symmetrical lows, right? Which is any lower high or any relatively equal lower high, which were not caused by SMT, right? So you would expect price to just gravitate to, these lows right here in regards to EU and GU, and these highs right here in regards to the US dollar index, right? And you can see that it was CPI, right? And price just rallied due to the fact that, right, there was intermarket sequential SMT. So yes, Michael teaches that, stay away from this. You don't want to be trading right here. But no, once we see this, and CPI is usually, right, the direction for CPI. It's not random. It's not like market maker's personal random button. It will, right, it will always, right, be in the direction in which we had a weekly sequential SMT. And it's very important, right? A weekly cycle sequential SMT, right? So here you can see, right, it looks symmetrical, right? But when you compare it to the interest rate triad, you realize that it's not. If we had sequential SMT between, like for example, EU and GU, or EU and the US dollar index, right? Then you wouldn't need to look for, price, you don't really need to look for anything within the interest rate triad, right? You would just, stay here, and anything here would literally be confirmed by the price action that's happening here. Because once there is sequential SMT here, there has to be intermarket sequential SMT, between the triads. Do you understand? I'll say it again. Once there is sequential SMT between, the triad that you're currently looking at, for example, if it happened between, ES and NQ, or between EU and GU, then you wouldn't need to, refer, back to the interest rate triads. Why is that? Because once, price action is out of line here, there's a cracking correlation here. There has to be a cracking correlation between at least one of these asset classes and all of these ones. More times than not, you will see, these moving, in sync, lockstep, like literally. And if you're someone that trade, the bond market, you'll be like, I can't find a cracking correlation. That's because the bond market, the 10-year note, the 5-year note, like they are just the gears which allow price to turn around, right? What happens is within the algorithm, you have EU, right, or the US dollar index, right? It does what it's supposed to do. That it just instantly reflects upon EU and GU. What happens, right? Is there a cracking correlation? No, there's not a cracking correlation. Okay, now what happens? It looks for information here. Okay, is there intermarket sequential SMT now? Is there a cracking correlation between any of these assets and this one? Is there one? Like, is there one present? If yes, then what happens? Price turns around. If no, what happens whenever price is not in sync, which allows, whenever price isn't in sync, for example, if you have the interest rate triad going up, the forex market going up at the same time, listen, if you have them going up at the same time, then you don't really want to be trading, right? There needs to be, they need to be moving lockstep. And what I mean by that is you need to see GU and EU going in the same direction as the assets that are in front of us right now. The US dollar, which controls, the US dollar is the link between everything, right? Literally. The US dollar links the forex market to the bond market, yes, to the bond market. That's literally how it is. It's like a bridge, right? So again, as I've said just now, the only time you need to look at this is if, you see price just, moving in sync on these time frames. For example, right now it looks like price is in sync, but still it turned around. It just reversed. And to someone, that will be, that's learning from me, and they hear me say that price only reversed when there was SMT, right? That is true because there was SMT. It was just intermarket sequential SMT, right? So on a regular day, days that you want to trade are when, right, you have intermarket sequential SMT between, for example, these pairs right here and these pairs right here, right? There are times when you will have all of these assets make a lower low, and all of these assets make these assets, which are the US dollar index, that would make, for example, that would make a higher low, right? I think I'm like losing myself right here. Been like so much sauce. But anyways, let's start over, right? So here, right, if the dollar index is making a higher low, right, and you have this making a lower high, this making a lower high, and then you have this happening right here, a higher high, higher high, higher high, right? This is a, cracking correlation between these two triads, and I just need you guys to understand that. And this is why you need to be referencing, the interest rate triads whenever you're trading this. But as I said before, and I'll say it again, the only time you need to do that, the only time you open this tab and look at it is when you see nothing here. And again, right, this is for everyone that's listening, right? Everyone that's paying attention, the people that, you haven't fallen asleep as yet. Right? You're waiting for the sauce. And here is it. Here it is right now. You've made it. So yes, whenever you see, right, the US dollar, right, moving in the same direction, right? If you ever see the US dollar moving in the same direction of the interest rate triad, do nothing. That's low probability. Even if there's quote unquote sequential SMT within, the current asset, triad that you're working within, it will be low probability. And why is that? Why? Can you tell me why? Why is that? That's because, like, literally the market is, and I don't want to say too much, but let's just say the market is being unclear on purpose, right? As ICT would call it, high resistance liquidity runs. What do you expect after, seeing the US dollar drop and then you have these drop as well? If that happened, what would you expect? Consolidation. You would expect, price swings that make no sense at all. No gaps being filled. Literally. Right? Just manipulation. That's what you would expect. So, and here, right, remember what we talked about. We talked about, and I'm talking about whenever we talk, where was it? I believe it was yesterday and Sunday. What were we looking for? We're looking for exactly what's here right now, right? Every week, there are, there are 1 to 2, sequential SMT, right? In regards to the weekly cycle, right? So there's either 1 or 2. More times there's 2. Sometimes if you're lucky, you can find 3. Are you paying attention to what I'm saying? Look at the charts right now. And reflecting upon your experience here, what do you realize, right? First of all, right, ICT teaches that, I believe that this is what he says. He says that 70% of the time, Tuesday forms had a load of week. Wrong. That's false. You can't prove that. That's a lie, right? That does not happen. Who's here from ICT's private mentorship and they realize that that's bullshit? That is bullshit. It does and I don't know why he says that. I believe he knows that that's a lie, but whatever. But I'm just here to let you know that's a lie. There's no day that really has the higher to low of the week, more times than not. It just depends on, what's present on that day. But I can tell you that using these concepts right here, the day that will have, or the days that will more than likely, more times than not, from the higher to low of the week will be Wednesdays and Thursdays. Right? Wednesdays and Thursdays, more than likely, more times than not. And this usually happens when there's no news event on Monday, no news event on Tuesday, but then there's a news event on Wednesday, Thursday, and Friday, or Wednesday and Thursday, or just Thursday. Right? When you're trading the weekly cycle, you're focused on the weekly cycle, you need to pay attention to the economic calendar. Just as though if you're trading the daily cycle, you need to pay attention to the economic calendar as well. Right? And I am not hiding anything, being mysterious. I'm telling you how it is. I'm telling you how these markets work. Look at this. We've been talking about sequential SMT for a while. And just look at this. Look right here. Right? And once, as I've said before, once you have sequential SMT, right? Once you have sequential SMT, between a triad, which, I would be referencing to a triad as, ES against NQ against the Dow, or the dollar against EU against GU. The only thing that we use the bond market for is to gauge market sentiment, is to see where we are, is to, determine what kind of conditions we should expect. Will price consolidate? Will there be a range in market? That's the purpose of, that for me. I'm not going to trade bonds. Yeah, sometimes, we know what it's going to do. Sometimes we're I'm not going to trade bonds. It's just like an actual indicator should be, if you know how to read price action. So anyways, here, right, we can see that we traded below Wednesday's low. And remember what I said before? Do you remember? I said that the lows, and I mean that, if the low or the high, right, is attacked first, right, the low of the day, wherever we had CPI, on the high of the day of, whichever day we had CPI, the day after, you would focus on the high, on the low. Here, you will find real premium and discount. You understand? Real premium and discount, right? So if price was trading here, and, we haven't been speaking about true opens that much, and that's due to the fact that I think that you already know what they are and you already implement them every day, which you should be doing, right? It's just a basic concept, like it's kindergarten, you should know this by now, right? So you can see that right here, we're below what? We're below the true week open. What else? We're below the true day open. So just as how you need two sequential SMTs, right, for price action to be, determined, for order flow to be, intact, readable, you need to have price trading below at least two true opens. And you got to write that down, right? Not one, just because they're sequential. Two. Nowhere, if they're trading below two true opens, right? And then there's sequential SMT, which you know that you need two sequential SMTs for it to be sequential SMT, right? For price to reverse, you need that. But when you have, price below two true opens, which is a higher time frame cycle, a lower time frame cycle, you have a higher time frame sequential SMT and a lower time frame sequential SMT. What happens then? You have price reverse, and then similar to SMT fills, right? We have other things that are similar, but it's not the same thing. So, for example, right here, right, and I mentioned that we would speak about the dispersal of liquidity, right, which happens, and this is just an introduction because right, it's just April. Right, so this is just an introduction. Yeah, so probably blow some people's minds, and then you'll begin to dig and understand more things. But looking at the charts in front of us, right, and then we'll go back to the sequence of SMT that formed the low of the week so far, of course, and pay attention to the true opens and whatnot. But what do you realize when you look at the market right now? You can see that here, right? The Dow, right? It barely rallied, right? And that is totally fine. This is literally what the Dow usually, do more times than not, right? Whenever it's not, in complete sync, or, the liquidity is not dispersed equally among all three. So, for example, right, say the market cap, and this is just, me just trying to get in your head, trying to make this make sense for you, right? Trying to explain it in an easy way. Say, for example, right, you have 100% liquidity, right here. You could say that this just has for example, 15% of the liquidity, that is available to all three. You can say that this right here is oh my gosh, I'd say 55%, 60% of all the liquidity, and then this has the rest. So this has 50, this has 15, this will have 35. Am I doing the math correct? But something like that. So, and again, let me try to explain it again. You have 10, basically. Number 10, here, you put 6 here of whatever. Here, 2, right? Or no, you put like, this will be like 1 and then 3 here. So the liquidity, right, should be equal, right? But here it's not. Most of the liquidity it was pushed where within the Nasdaq, and coincidentally we had Nasdaq making a higher high, which would indicate higher prices, without even thinking about this, right? And how could you know which one will expand more? First of all, yeah, right here, higher high, higher low. My bad, higher low right here. Here you can see that price closed below this low, which suggested already, right? And let me use this, right? Price closed below this low here, which suggested that this was weaker among all of these, right? Here, price closed above the low, but it closed below the lowest close of the previous day, right? And due to the fact that this happened, right? Price rallied here, right? And when price rallied here, it closed above this high. That was a shift in market structure, a real one. Here, closed above this high, right? Price fell, traded down into this gap. It went over, right? They dug into this down close candle here. And I'm currently talking about the ES, right? Whereas here we had price just trade within this gap. So price, price action. And this is why I like the Nasdaq more, because whenever we have these conditions, then the Nasdaq is usually the best thing, right? So the Nasdaq traded here, and turn this on, fell on a new day opening gap, right? Fell here, but look here now, right? This is like literally what I was trying to get to, right? Look at the Dow. Do you see that? Pretty sure that you do. So, right, we have the Dow taking this low out, right? While, right, the Nasdaq was trading into a gap. This, traded over the gap, but the close was, basically within the gap, dug into this candle. So we had what? SMT here. Whenever, right, you have a higher time frame SMT and then you have a lower time frame SMT afterwards, whenever you have two of the three, triad that you're working within, for example, ES made a higher low, NQ made a higher low, but the Dow made a lower low. These will expand more. These will move more. Why? Because this is weaker. Why is it weaker? It took out the lows, literally 2 times in a row. Like, it's like, thank God that it even took this high out, right? And this isn't a problem. Why? Because we don't really trade the Dow. We focus here, right, on these two. So whichever of these two that you like, then yeah, these are the ones that you would trade. Also, look in here. What would even make us, consider this right here? And this is probably the most like this day. Literally this day with the exact condition CPI before Thursday, like literally everything, nothing is random. If we have the same news events that happen today on the same date, the same day in another month with the same conditions, then we're going to get similar results to what we get to what we got today, because prices are random, right? Here, right, I am going to take the lipstick off. Look at the monthly cycle. Go to the forward time frame because we use the forward time frame for the monthly cycle. And what do you see here? Right? This was the low of the previous week. Right? We traded below that. This was the low of the previous week, looking at the ES. Did we trade below it? No, we did not. No, we didn't. And then, right? So going here into this week, there was already, right? Well, not going into this week, but like, after Wednesday, there was sequential SMT, right? Look at the Dow. Dow is still below that low, as you guys can see, right? So the Dow has a bit of keeping up to do, like catching up to do. Not keeping up, but catching up to do, right? The Dow has a bit of catching up to do. Have equal highs here, right? And if you guys remember, we were actually, looking for price to be drawn to these highs, looking at the not ESD, NASDAQ right now in Q, right? These equal highs, we're looking for price to be gravitated towards them, right? We had sequential SMT between, the monthly cycle, between Q1 of the month, Q2 of the month. Then afterwards, and this is literally the perfect, the thing that you're looking for, the thing that you need to focus on, right? Then we had sequential SMT in a lower time frame cycle, which occurred here. Occurred here between Tuesday and Thursday, right? So we had sequential SMT here on the higher time frame cycle, right? The monthly cycle. Then we had it, within the week, right? Between 2 days, right? Look at how the NASDAQ, expanded higher, right? Taking out the previous day's high, where these failed to do so. First of all, right, the reason why the Dow was this weak, you can see, is because the Wednesday closed below the previous week's low. Here, right, we have a little bit of strength here, right, due to the fact that, Thursday closed above this low, but due to the fact that the NASDAQ closed higher than both of them, then we would expect the expansion to be here. And we could literally, based on this, we could literally expect price to go higher or expect, a failure swing to form due to the fact that this was already present just by how price closed on Wednesday. And again, if you guys remember, like I don't know, do I have to like clip it and post it in the group? Like I hope most of you guys watched like Sunday when we were, doing our analysis, right? We refer to this low and we expected sequential SMT already. And I pointed to the specific day, right? Literally. Yes, we did. And the reason why, remember why I said that these lows were important is because what? Here, let me say it again, right? As you guys can see, right? This low right here, and now we're looking at the ES, failed to take out this low, right? Friday failed to take out Thursday's low. Here, and this is for like liquidity purposes, right? You can see that price did, in fact, trade below this low by a bit. You can see a little bit right here, but it did so it counts, right? Here, price failed to trade below this low, right? So as soon as you see things like this happen, right, and due to the fact that there was no closure, so this was obviously not, the actual reversal, right? This was just, engineering a pathway for, CPI to, manipulate upwards, take out these equal highs, drop, have everyone think that price is, bearish, and then just turn on them on Thursday, which happened, right? So here you can see the price traded below this low, which was caused by SMT, right? Failed to trade below this one, traded below this one, and then after that we had sequential SMT again. If you focus on these highs, they're all wicks. Whenever you see, price just, showing wicks like this, right? Then, you can expect, price to gravitate to them once there is sequential SMT, right? And something else that you should know is it's not just sequential SMT alone. You need to have a news event behind that. Do you understand? You need to have liquidity, an injection of liquidity, which are literally scheduled. You can see them, weeks before, months before, even years before. Because they have to do the same thing at the same time for price, to be what it is, fractal. There's nothing new under the sun. Like this exact price action will manifest itself, within the 90-minute cycles, which are ruled by the daily cycle, of course. It will manifest itself, in the quadrennial cycle. It has, and it will even higher time frame cycles, and it won't change. And literally, this is just the beginning. I hope that you guys found something, insightful from all of this. And I hope to share more with you next week. Have a wonderful night.